So thank you for offering me the opportunity to present you ERAF, a quite young pension scheme set up 7 years ago. It works. Okay, so this scheme was set up 7 years ago to make possible for 4.6 million French civil servants to contribute for an additional layer of retirement benefit, contributing on their variable revenues. The beauty of being young is that when you are a pension fund, you have a very long ramping up period. So we are at the very beginning of this period. We are getting 1.7 billion euro a year, and the net positive cash flow, as we don't pay much now, is 1.5 billion euro on average for the next 20 years. So liquidity definitely is not an issue for us. So it means that we can think long-term, and we can invest for the long term. This graph shows you the sequence of the cash flow. So at the end of the ramping up period, the total amount of assets we should manage should be close to 100 billion euros. We think that there is a link between intergenerational equity and sustainability. I will insist on that. There is a proxy for sustainability for a pension fund, which is the technical yield, meaning how much I get for how much I paid. But that does not mean much for the people, in the streets. So there is a better proxy, which is the implicit life expectancy that is built in your pension fund. What does it mean? It means how long does it take for you to recoup your investment? You have paid contributions, you get a benefit. So how many years will it take for you to get back, to get your money back? So people can understand that. Obviously, if it takes 50 years once you're retired to get your money back, this is flawed. But most of the time, it's exactly the contrary that's happening, meaning that you get your money back in a much shorter period that would be needed. And I know retirement schemes in France, for example, that were offering technical yield of 12%, meaning that it took only 8 years and a half to get your money back. So are the young contributors really aware of what's happening? Are they aware that in some way they are fleeced? I don't think so. So I think there is a very inconvenient truth. It may sound like a truism, but as Herbert Stein, the economist, said once, what cannot last forever will stop. So a retirement benefit scheme should not be offering benefits, generosity of which is paid by the young contributors. And this is on the liability side, if I may say so. But if we consider now the way we invest, can we invest in a way that exhausts, to put it in a broad way, the nature of the economy? I don't think so. I've been trying for a long time to find, example that would say something, once again, to the average people in the street. This question of sustainability. And even if we are, most of us, living in cities, we still have, links with the country. And we know, for example, that if we exploit forestry, cutting the trees at a rhythm of 10% a year, maybe we will have quite a good period of 10 years. We will change our cars or house. But after 10 years, there won't be any trees left. So, sustainability, I think, is really at the core of what we are talking about. And examples of that, what happens when you have been too over-optimistic in the assumptions that you use, to calculate the actuarial value of your liabilities? We have many, many examples. And I think it was in a Bloomberg article I read a few weeks ago that there was a very explicit title saying that Illinois State Pension Fund was beyond repair. And this is something that is quite scary. For us, obviously, it's much easier because we started from scratch. And, you know, starting from scratch makes possible for you, you know, to try to avoid maybe errors that some others may have committed before. So when ARAF was set up, two choices, very fundamental, were made. The first one was to put intergenerational fairness at the core of its management. I won't go deeper in the first bullet point, the advantages of a point technique, but you will find, you know, more about that in the appendices of the presentation. But basically, it's a way to calculate your annuity in a way that ensures the intergenerational fairness, because you have a price to pay to buy a point. For each point, you know in advance how much annuity you will get when you retire. So the problem for the Board of Trustees is to manage that equilibrium, that balance between generations. The second bullet point is very important. It's the pricing of, you know, the promises you are selling, if I may say so. So this pricing was set at a very prudent level. I will come back on that. The second choice that is very important was to decide to invest according to our own SRI grid, own SRI charter. Why so? Because I think it's, there are three values, meaning social issues, governance, and environment, that are the big issues that will determine the passage toward a sustainable economy, to summarize. The second point I will come back on is the choice that was made at the very beginning to adopt a very pragmatic approach, meaning that we have to deal with the world the way it is. There is no magic wand, unfortunately, that would make possible to switch towards the new world we are hoping for. No, we have to address the complexity of the world as it is. We have to accept that we will need oil, cement, whatever, for a very, very long time. But not all the companies, you know, in those sectors are behaving the same. So why is the pricing so important? Pricing is important because it's the moment where you set the conditions of sustainability of your scheme. 1.34 is the minimum level of return in real terms we have to get in order to reserve the liabilities plus the cost of managing those liabilities until we have paid the last benefit to the last pensioner. If you add 2%, which is what the ECB is aiming at in terms of inflation, it means that in nominal terms, the minimum level of return we have to get is 3.34. We have been criticized a lot in France for being too conservative. But, you know, what was deemed very prudent a few years ago, now it's just prudent. The 10-year bond was paying 1.20 not so long ago. I don't know how the 10-year treasury bond is paying here, but 180, 170, something like that. So, you know, things have changed. And unfortunately, we have, or maybe we were too optimistic, but we have discovered that the so-called riskless asset, maybe was not so riskless. And the Greek default was a proof of that. So 1.34 is what is needed to be funded in real terms. But it's not enough for a pension fund, because you also have to make reserve. Because you have a morbidity table drift. You may have external shock on your variable revenue assets, and there is the operational risk. And if you want to be able to make revalorization of benefits, you have to do much better than that. So this very prudent reserving helps us a lot to weather through the crisis. And once again, the problem with discounting rates is that if you have been too optimistic in choosing this pricing rate, equal discounting rate, and if your investment is not able to deliver the same amount, at some point you will be short. There will be money missing just to ensure that you will be able to deliver on the promises that you wrote. And if someone who was 20 years when he joined ERAF 7 years ago, the good news for him is that he is still young, he's 27. But the very bad news for him is that it will take 40 years for him before he retires, at least. So it's a very, very long promise. So using that very conservative discounting rate, and after reserving for the loss on the Greek bond portfolio, for the decrease in the rates, for capital losses on the stock portfolio, we still are reserved up to 106, 107%. It will depend on the level of the stock market at the end of this year. But nevertheless, we are much above 100%, using, once again, a very conservative discounting rate. I'm always amazed when I go to seminar or conferences when there are, CEO of pension funds saying, my pension fund is XYZ% reserved. If you don't have your discounting rate, it does not mean anything. So it's 106 or 107, but with this very...
What do you think, Philippe, of US pension funds that have these target rates of 7%, 8%?
I think, unfortunately, they have no choice because, once again, I have to be frank, it's much easier for someone who started from scratch than for someone who has to deal with what he inherited in some way. I think there are some sort of coalition of interest at the very beginning of most pension funds in the States where, especially for public pension funds, where politicians did not want to raise, resources to raise contributions, and employees were not very keen either to pay more. So I remember I was curious enough to go on the website of California Congress. And in 1999, they increased the benefits for teachers in California. Logically enough, they should have raised the contributions. But that very year, the expected return of CalPERS was raised by, I don't remember, 25 bips or 50 bips, et voilà. So there is some sort of magic about actuarial calculations. But, you cannot cheat with reality. But the problem is that it will take a long time before, what is virtual becomes real. If you jump from the Empire State Building, even at the 5th floor, you can say, so far, so good. The problem is that at some point you will hit the ground. And, I showed the example of Stockton Country, but there are, you know better than I, but there are many pension funds that are in really dire straits now. Because, once you have strayed away from what I call the sustainable path, it's very hard to come back on the right track. Let's take, just to come back to the example of forestry, when you have a very young tree, to help this young tree to grow vertical, you put a little stick, in the ground. And if there is an angular gap at the very beginning, it's very small, maybe 3 degrees. So the distance between, where the tree is growing on the vertical line is narrow. 10 years after, the angular gap is the same, but the distance to come back in the vertical line is much bigger. And the trees is huge. And can you imagine the impact of, decreasing the discounting rate by 200 bips, multiplied by the duration of liabilities? It's really almost impossible, I guess. But at some point, something will have to give, either way, contributions or benefits. And I think, once again, it's a question of intergenerational equity. The problem is compounded by the fact that there is no more inflation. So the trick that would consist in churning out bits by bits the benefits of retirees, it's almost impossible. So we have to decrease those hidden liabilities in real terms without the help of some, monetary illusion, and it will be quite difficult. Oops. So, once again, and I want to be frank, I'm running a mandatory pension fund. So, once again, it's much easier. I have to be frank on that. The choices I described were based on, assumptions that first, the fact that we are a long-term investor. And we think also that trying to maximize the immediate profit is detrimental to sound and sustainable business. So it will explain why also we prefer to adopt a best-in-class policy. So what is at stake? It's quite simple. We think that we may regret it or hope for it, but we are going towards a new economy. And what will determine this new economy is the fact that we are discovering that scarcity will impact our lives. We had forgotten that. And secondly, we think that externalities will be more and more internalized. It may sound pompous, but well, I guess we all know what we are talking about. So the question is, if we accept those starting points, should SRI remain just another layer, the icing on the cake, or something that is just marginal, a layer in your assets, or should it be, part of your investment process itself? For us, it should be part of the investment process itself. It's a way to select, assets, taking into account the ability of people, responsible for those assets, to deliver not for the next year, but for, the foreseeable horizon. So, as I said, we think that best-in-class really makes sense. Because, once again, when you are a big pension fund, you have to accept that you will be part of the big game. You will be buying less or more of a market. You will have to accept that, you cannot invest only in wind farms, social companies, whatever. You have to accept that you should not have any bias. So this is our case. We are a public pension fund. Whatever is legal in France, we can invest in. Nuclear power, for example, defense industry, whatever. After we take into account SRI performance and also financial performance, obviously. So what do we promote? We promote a global but also a pragmatic approach. We have no sector bias, as I said. We try to talk to other pension funds because we want to be more effective in the way we will engage with companies. We try also to convince our own asset managers that SRI analysis should not be only, applied to a small part of their, business, but it should be integrated in their investment processes itself. And we are also working with, providers of indices to develop new kind of indices that would promote best in class or on SRI approach. So if we want to be effective, you also have to go one step further. And that's the reason why last year we decided that we should have our own guidelines to engage with the companies we are investing in. So if you are interested there is an English version available on our website. And it's true that for too long a time, institutional investors have been quite consenting victims or sleeping partners. And it's quite unfortunate because we provide the fuel or part of the fuel for the engine that are the companies. And so we should be more active, not confrontational. We don't, engagement for us is not a fight, it's just a dialogue. Maybe sometimes it could morph towards something more confrontational, but at the start it should be, exchanging ideas on trying to improve, the way the management consider shareholders. And as Roger, not Robert, that's a typo, said, we should behave like, we should act like conscious universal owners. This is really important. And, obviously there will be a lot of pushback against that. But once again, if we are, united, meaning if we talk to each other, there is this platform with UNPRI that is a start, for example, where asset owners can exchange about, the way they want to vote for annual general meetings. I think things could change. And once again, I think that the big business at some point will realize that there is much more to be gotten from adopting this new behavior rather than to resist it. And once again, it's a way to discriminate between the companies we want to invest in. So to sum up what I said, I think the problem is how we're able to learn from our errors, and the faster we can do that, the better it will be for us. Thank you.